Hey everyone, welcome back to the channel, your number one source for income-oriented investing. And I haven't done a video on split share funds in Canada in a really long time, so I figure I'd do another one here. And in today's video, we are going to go over the 6 key and core concepts you need to understand about split funds. And then at the end of the video, 2 very, very important reminders, especially the last reminder. So by the end of this video, hopefully you'll be much better educated, much better versed in what split share funds are and how they work. So the first thing you need to understand, very important, and we're going to use existing split funds as an example, is that split share funds are closed-end funds. They're not ETFs. So the biggest thing, what does that mean exactly? You could still buy and trade them like ETFs on the stock market, right? Buy shares, sell shares, etc., except they have a fixed set number of shares. That's really the big difference between an ETF and a closed-end fund. There's a set number of shares. So in order to create more shares, unlike an ETF, which it's based on supply and demand, shares are created every day if there is a demand. Closed-end funds, it's different. There's a set number of shares. They can increase the number of shares, and we'll talk about that in a little later with the ways they could do that. So that's number one. They are closed-end funds, not ETFs. But the biggest or more practical thing to understand of closed-end funds brings me to point number 2, important concept number 2, and this is extremely very, very important and really is a consequence of them being closed-end funds and not ETFs. So one consequence is that the share price can deviate from the net asset value or the NAV price. So for ETFs, the NAV price and the actual share price, so the net asset value is actually what one share is worth. Okay, that's the NAV price. And then there's a stock market price or the market price. That's what they're being traded for on the market right now. For ETFs, they're usually very, very close, if not identical, but for closed-end funds and split funds, they could vary. So for example, we're looking at DGS here, a popular split fund from Brompton that's been around for over a decade. You see that as of June 17th, the stock price or the market price is $6.87 a share, but the NAV, the net asset value, is $7.06. So it's a little bit higher than that, which means the shares are actually trading cheaper than what one share is actually worth. So in this case, in a case like DGS right now, the shares are actually trading at a discount. So it's very important you understand, this is the second core concept, the NAV versus the share price. If there's a discount or there's a premium, are the shares trading at a discount to NAV or a premium to NAV? So right now, DGS is trading at a discount to NAV because it's cheaper than the net asset value. If it was higher, it would be at a premium. How do you calculate that? You take the market price, 687, divided by the NAV price, 706, minus 1 times 100, and you'll see it's 2.69 whatever percent, let's just say 269. So DGS, the Class A shares, are trading right now as of June 17th at a 2.69% discount. So if you buy them, you're actually buying them 2.69% lower than what they're actually worth, the NAV price. So this is a very, very important concept to understand, number 2. Number 3, of course, is the difference between the Class A shares and the preferred shares. You could see that right here. There are 2 separate listings on the stock market. So if you look up DGS, you're going to see 2 separate stock symbols, DGS and DGS.PR.A. Obviously, the one with the .PR.A are the preferred shares. And these are completely different investments, but they're tied to the same portfolio of stocks, which in DGS case is dividend growth stocks in Canada, right? If you look at the portfolio, you'll recognize a lot of these companies. They're basically primarily dividend growth stocks, high quality blue chip stocks in Canada. It's very important to understand the difference between the two. So the preferred shares act kind of like a regular preferred share. They get the priority when it comes to the dividends of the stock. They get the priority for everything, basically, and it's basically almost like a fixed income investment. The preferred shares don't go up or down based on the stock prices of the portfolio. So they're much, much safer. They're considered a fairly safe investment, I would say, a very boring fixed income type of investment. In my opinion, it's almost like a GIC alternative. Of course, it's a little bit riskier because you're still tied to stocks, but it's not moving based on the ups and downs of the portfolio. It's really they're capturing. They don't. That's why they don't go up or down much. If you look at any stock chart of preferred share, they typically hover always at about $10. That's because if the stocks inside the portfolio go up or down, it actually does not impact the net asset value of DGS.PR.A, for example, which is why the net asset value is typically always around the $10 mark. Of course, the market price could be higher. So in this case, for example, like we learned in lesson number 2, important thing, core concept number 2, this one's actually trading at a premium, not at a discount, because the market price is higher, 1075, than what it's actually worth. So this one's actually trading at a premium. So preferred shares, very safe, very boring. They don't benefit, let's say, if this portfolio of stocks goes up and up and up and up. All that benefit goes to the Class A shares. So Class A shares are participating in the full movement of the stocks inside the portfolio, hence its leveraged nature. So this is why the Class A shares are basically a leveraged investment in this portfolio of stocks. It's a leveraged investment because all the stock price movements of the portfolio goes to the Class A shares and none of it goes to the preferred shares. So very important core concept number 3, you got to understand the difference between the Class A shares and the preferred shares. The preferred shares are really designed for consistent, boring, fixed income, if you will. The Class A shares for a lot of growth, right? For enhanced growth, because you're getting leveraged exposure to the portfolio of stocks. Another important concept to understand is that closed-end funds, split share funds typically reset after 5 years. So I keep getting a lot of questions about this. What happens when the maturity date comes? Sometimes you'll see the reset date, the maturity date. So for example, DGS, the maturity date is in August 30th, 2029. What happens as a fund closed down? You lose your money? None of that happens, everyone. It just means that because the preferred shares are kind of like a bond, like a fixed income type instrument, every 5 years, the yield or the dividend rate is reset every 5 years. So that's why split funds have typically a 5-year reset period, 5-year term, but they will typically always extend, everyone. So you don't have to worry about losing your shares or the fund closing down or anything like that. So the fund is reset every 5 years. The preferred shares get a new dividend rate and everything moves on, basically. There's a lot more to it than that, but that's basically it in a nutshell. You don't have to be afraid of the maturity dates or the wind-up dates. There's other little things involved as well. At the maturity date for the preferred shares, you could hand back in your shares at a certain price, but that typically not many people do that. But either way, I don't want to get into it. I don't want to confuse you too much, but just to say, don't worry about the maturity date. It's very, very normal. It resets every 5 years. Okay, and they typically extend it, especially when it's a very, very popular fund like DGS, which has been around for 10-15 years now. So it's been reset three or four times already. The next one, important concept number, I guess we're at 5 now to understand. Second last one is, I get this question all the time, overnight offerings and at the money equity program. So remember at the beginning, I told you that there's a set number of shares. The fund manager or the fund can issue new shares, but they have to do it in typically 2 ways. Either they do an overnight offering, which means that overnight they will issue a whole bunch of new shares at a certain price. And if you want to look at an example, let's look at an overnight offering that DGS did in March 2nd, 2022. So what you'll see is basically how many shares they're doing, and the most important thing is what is the share price that they're going to be issuing the shares. So you see here it was $6.87 for the Class A shares and $10.07 for the preferred shares. Now the most important thing to remember is that typically the day after an overnight offering, the share price, especially of the Class A shares, goes down a few percent. That's because they're flooding the market with new shares. But many investors think that this is dilutive or it's a negative thing, when in fact it's the opposite. And you can see right here, overnight offerings are non-dilutive, and actually they're accretive. So overnight offerings are actually a good thing for existing investors. So why is it non-dilutive? Because by law, they could only issue new shares if the fund is trading at a premium, not at a discount. So right now they can't do an overnight offering for DGS, but let's say the stock price was $7.50 or $8, then they would probably do an overnight offering at $7.50 or $7.60, which means they're issuing shares higher than the net asset value, the current. So it's not dilutive to the existing shareholders. Okay, so overnight offerings, always a good thing, but it's sometimes perceived as a negative thing because the shares drop the next day, but that's because they're flooding the market with new shares. It's completely normal, but just remember, it is not dilutive, not dilutive. Another way they do it, and this is more, they've been doing this more and more, is what they call at the money, renews at the market equity program. Sorry, not at the money. That's I'm thinking about covered calls, at the money options here, but it's the at the market equity program. This is similar to an overnight offering. They're issuing more shares at a certain price that's not dilutive, I believe, at the market price. Remember, they can't dilute, but they're doing it very, very slowly and a little bit every day at their discretion. So it's just another way to issue more shares. They, instead of doing it in one shot, like an overnight offering, they're doing it a little bit at a time at their discretion. They'll issue more shares. So it's completely transparent. But if you hold any split share funds, you'll probably get these letters in the mail, by the way, of all these announcements, because they're technically corporations, right? And you're an owner of a unit of the corporation, so you'll get notified. And I always get the question. So when you see this or an overnight offering, everyone, don't be scared. It's non-dilutive. It doesn't hurt you on it as an investor. In fact, overnight offerings, especially in the community, they're very popular because it's a great time to buy more cheaper shares the following day, because there's always a 2-3% drop. The last and number 6 to understand is that the preferred shares, there's a set, typically monthly or quarterly. Brompton, it's quarterly dividend that they'll always get. But the Class A shares has a monthly distribution. And by the way, the monthly distributions on almost all split shares are always about 10 cents a month. The unit NAV. So we know what the NAV is. The NAV of the Class A shares is 706. The net asset value of the preferred shares is $10.02. The unit NAV, number 6, is you have to understand what the unit NAV is. It's just the combination. 1002 plus 706 is the unit NAV of DGS. So it's about $17, let's say, a little over $17. Now, for the Class A shares to get their monthly dividend of 10 cents, the unit NAV has to be over $15. Right now, it's good for DGS. It's $17. But let's say DGS, preferred shares always typically stay at $10. But what if DGS goes to $4? 10 plus 4, that's 14. So the unit NAV would be less than $15. That means there would not be a dividend that month for DGS holders until the unit NAV goes back to 15. Now, a lot of people see that as a negative thing, but the purpose of that is to maintain the fund for a really long time. If the market goes down really, really quickly, remember DGS is leveraged. DGS Class A share price could go down very, very quickly. So to protect the integrity of the fund for the long term, they will temporarily suspend the dividend, the monthly distribution of 10 cents a month for the Class A shares if the unit NAV is under 15. When it goes back over 15, so it has to be 15.10. Basically, it has to be 15.10 because they need the 10 cents to give out. Remember, the monthly distribution, 10 cents, that comes out of the net asset value. Right, so a lot of people see this as a negative because they want consistent income, but some investors see that as a positive because they're just Yes, you're missing your dividend that month or for 2 months or for 3 months, for however long it takes for the unit NAV to get back to 15, but they're really trying to preserve the fund long term. So that is something you need to understand if you're going to own these Class A shares and you're looking and you're reliant on consistent monthly income. Well, maybe Class A shares, of course, it depends on the history of the fund. How many dividends have they missed in 11 years or 15 years? Some of them have never, ever missed a dividend. For example, Middlefield, they have 3 split share funds that have never missed the dividends on their Class A shares. Again, this is only for the Class A shares, not the preferred. They're very, typically very strong, right? So for example, eSplit Corp, which invests in Enbridge, the unit NAV right now is over $26. Very ahead of the minimum $15 needed to pay out. So that one is no danger. But something like a DGS, that's a lot closer at $17 unit NAV. Well, that could be more susceptible to sometimes missing dividends. Of course, it really depends on what the portfolio of stocks does. And remember, Class A shares are leveraged. They're leveraged investments, which is typically long-term, gives you a lot of really good performance, right? If we look at the performance in the last 10 years of the Class A shares of DGS, it's almost 15% a year. That's amazing performance. The preferreds are only 5.6. They're always going to be near the 5.6 mark because they typically give a 5% dividend, and that's it. So hopefully that makes sense, guys. That is the 6 very important things to remember when it comes to split share funds, very important concepts. And just a reminder, everyone, that I have many split share fund videos, everyone. There's just so many of them. In fact, I have a playlist that's just for split share fund videos. I have really long Q&As with Michelle from Brompton that we talk about split share funds in detail, with Dino Rico from Middlefield, where we talk about split share funds. And I could promise you one thing: any question you have, it's already been discussed in those Q&As in my past videos. So make sure to check out my past split share fund videos and the playlist if you want to learn more. Now, the 2 last very important things, reminders that I want to remind you of is, when you're investing in a split share fund, you got to look beyond the ticker. That's a very important reminder, number 1. Look beyond the ticker. You're not investing in DGS. People think, I'm going to get DGS. Well, what is DGS? When you buy DGS, you are investing, and we're talking about the Class A shares, right? A leveraged portfolio of these holdings, of these stocks. Your fate is tied to the holdings. All right. So if you're investing in DGS, this is really what you're investing in with leverage, right? With leverage. So very important. You got to look beyond the ticker. If you invest in ENS, for example, you're investing primarily in Enbridge, just one stock. In the real estate split corp, you're investing in Canadian REITs. In the infrastructure dividend split corp, companies that deal with infrastructure. You're getting my drift. Very important reminder: look beyond the ticker. Extremely important last reminder is that if you don't want to deal with picking and choosing your individual split share funds, you still don't understand them, you're having a hard time swallowing the concept. I agree, it's much more complicated than ETFs. There are all-in-one ETFs that you could invest in, which make your life just a billion times easier. So if you are interested, if you're a conservative investor, you looking to park cash, maybe you're happy with a 5% yield for some reason, and that's what you want, but you don't want to pick DGS preferred shares, or do I take the ENS preferred shares, or there's maybe 20 to 25 split funds in Canada. Even Quadravest is another one, DFN, right? You don't want to pick and choose. There is the SPLT ETF from Brompton, which is an actively managed ETF, which holds a combination or pretty much all the preferred shares of the split fund. So this is a very, very convenient option. If you look at the portfolio, you see that it owns Dividend 15, which is DFN. It owns Dividend Growth, which is DGS, what we just saw. But the preferred shares of a bunch of split funds together. So you're getting a massive amount of diversification within the split fund preferred world. So SPLT, very popular ETF, over 500 million AUM. You'll get a very consistent, 5.5 to 6% yield, something like that, but not more than that because this is really the preferred shares. Quadravest launched their own. It's called Pref, similar concept. And there's even SPFD, which Mulvihill launched. This is basically the same concept, but they felt that it's the preferred shares are so safe that they added 50% leverage to this ETF. So this is an ETF again, like SPLT and Pref hold all or many split fund preferreds, but they added 50% leverage, which means you'll get a lot more yield. And we talked about it. Actually, my video is actually on their website. We talked about this one in detail as well if you're interested to check it out. So again, if you're interested in the preferred shares, you have an all-in-one ETF option, SPLT, Pref, or SPFD if you want a lot of leverage on that. And for the Class A shares, which are my personal favorite one, I wouldn't consider the preferred shares, they're just too boring for me. Brompton launched Class A, CLSA ETF, which is an ETF that actively invests in all the Class A shares split funds in Canada. You have Dividend 15, you have Life and Bank, which is LBS, you have FTN, you have FFN, you have ENS, BK, Brompton Split Bank, which is SBC, Dividend, Growth Split Corp, which is DGS that we just saw. So basically it combines many of the Class A shares together, so you don't have to worry about picking and choosing. It's a super convenient ETF, which has approximately 10 to 11% yield, everyone. So that's the last reminder. The last reminder is you have all-in-one ETF options. If you're interested in these split fund shares, which have a lot of history, and history has shown that they've pretty much beaten the respective indexes, right? Like DGS and stuff like that. You can see that they have a really good long track record with superior returns, but they're very volatile. And sometimes they miss dividend payments. That's probably the number one concern or problem income investors have, is the unit NAV rule, right? Which we talked about. Well, Class A ETF has solved that problem because their intention is to always deliver monthly income no matter what. And of course, there's a video where we talk about this with Brompton on my channel in detail. They also have some material on their website. So again, last reminder, everyone, you want to skip the complication and want to pick and choose, you could always go with an all-in-one ETF. Give me a thumbs up, everyone. I would really appreciate it. I know I was talking a lot and there's a lot to digest, but these are really the 6 core concepts you need to understand if you're planning to invest in a split fund. And very important reminder, look beyond the stock ticker. You're really investing in that portfolio of stocks. And of course, final very important reminder, if it's too complicated for you, you could always just get the all-in-one ETFs managed by Brompton, one of, if not the top split fund manager in Canada with a lot of experience. Much easier, and you're not at risk to miss any dividends. So once again, guys, give me a thumbs up. I'd really appreciate it. Check out my other split fund videos on my channel. There's so many of them, specific playlists just for that, and see you next time.